Hello and welcome to the Accredited Investors Only podcast presented by Accredited Life. I am your host, Peter Neal. Hello and welcome to another great episode of the podcast. I'm so excited for you to be here with us today. This was a really great interview with a really great guy who has a ton of experience in the real estate space and in something that really fascinates me, student housing, multifamily projects and investments. So I'm really looking forward to getting into that interview. But before we do, I just got off of another amazing interview that we have lined up to come later in the future for the podcast. And something that had come up in the interview that we talked a lot about that I wanted to just share now, because I always like to take a few minutes before the interview when I can to talk about, a topic that I think might be helpful in your life and in your investing. And I always like to ask, are you living your accredited life? That's what this podcast is all about. And I think one thing that's so important that you need to be doing is really having great conversations and really valuing the importance of a conversation. In this day and age that we live in, where everything's on the phones, and on over computer and email. I think there's something to be said for that. I mean, I've certainly, when you have certain questions about an investment or about a project or a company or something like that, certain things are good in email because it forces the other person to write something out. It forces them to write it well, hopefully, and to write it simply so that you can read it and understand it. But there's always certain context that an email just can't provide. So I really think there's a time and a place for both. And what I would do is I'd challenge you, if you're somebody who tends to always want to do things through email. I'll email the guy, or I'll shoot him a text or something like that. I challenge you to pick up the phone and call. Schedule time to call and see where that takes you. In a there's so much magic in a really good conversation because you never know necessarily where it's going to go. And during the conversation, there could be things brought up. Typically there's, banter that goes on and things about the weather or where you went to school or, obviously the Eagles just won the Super Bowl. I'm a Philadelphia guy. That's something that you talk about. So world events, events happening in the country and things like that. You talk about those kinds of things that would never really come up in an email. And you never know where that's going to take you. You never know what door that's going to open, and maybe a referral for something that you've been looking for, or something you didn't even know you needed that you were looking for. You just really have no idea where that conversation is going to lead. And a lot of times it might not lead anywhere necessarily, and you might not have a connection with the person you're talking to. But I think the times that you do have it, it's worth doing that more often. So I challenge you, if you're somebody that, likes to, for the sake of convenience or time or whatever it may be, do things over email, text messages, things like that. I challenge you to take the time to, maybe make some phone calls in the next week or so. And see what happens and see if you think it's worth it or not. And you might be surprised. I think in this business, where there's kind of two different ways of looking at the business, from the logical side of what do the numbers look like, and is it a good deal? Is it a bad deal? What's the basis? How are you adding value? All that kind of stuff. And then there's the opposite end, there's like kind of the emotional side of things. And they're based in some logic as well, like the team and the operators and the players and who's managing and who's doing this and what's their experience and their track record and all that kind of stuff, and what's the story of the deal and that kind of thing. Those are so important. One of the things that came up in the interview, in the conversation, was you can have really, all the numbers can be great on paper, but the operator, for whatever reason, they have things going on. Maybe they're not, totally on the up and up from a kind of moral perspective or something like that. And the on paper numbers and underwriting and due diligence and analysis and, that story on paper didn't come to, reality in real life for other reasons. And those things, you just, the team and the values and the morals and the understanding of that side of the story, is just, that's a lot harder to do in an email. That's really done best, I think, over the phone, even better in person if you can make that happen. So that's just my 2 cents for the day. I want to get right into the interview. We have an amazing guest today. I really enjoyed this conversation. He works for Ashland Capital Fund, which is a company that I know, have known for many years and love very much. Alex Kogan, who has started that and runs that, is a friend and somebody who I think really does a great job at what they do. And Greg is the Senior Director of Acquisitions and Investments for Ashland Capital. His name's Greg Bronson. He has 18 years of residential real estate experience. He's managed over $2 billion in transactions, including student housing, multifamily, and senior housing. He is an adjunct professor at the NYU Institute of Real Estate and was a former director of investments at Saxum Real Estate. He founded Ash Real Estate, no relation to Ashland Capital. That was there. He put together a senior housing portfolio and did senior housing projects. He did that for 12 student housing portfolios. I'm sorry, I think I said senior there. I meant to say student housing. He has led various roles, senior roles at Red Oak Acquisitions and H2 Capital, and he began his career at Lehman Brothers. These are all things that we talk about and get deeper into the conversation. He's a Princeton grad, very smart guy, great background in equity, debt, and real estate investment. Really had a great conversation with Greg. Let's get right into that interview.
You're listening to the Accredited Investors Only podcast, presented by Accredited Life.
Greg, welcome to the show. How you feeling this morning?
I'm doing great, Peter. Thanks for having me. How about yourself?
I'm feeling very good. Very good. It's a good day. It's the year's starting off well, and it's not snowing anymore, and hopefully it won't be. So that's always a good thing. You get a lot up your way there, or you said you were in New York, like Westchester County?
Absolutely.
All right.
We've had I mean you've had the same, right? It's been a cold and snowier winter than the last couple.
Yeah, but which wasn't hard to beat. The last few have been pretty. Growing up, there was always a lot of snow, and it's just the last few years have been kind of mild. So, and you get used to it. Yeah, it's just like, I mean, I don't mind it at all. Not that I don't like a good snowy day, but it's like that's it, like a day. I don't like it lasted much longer than that, right? Well, before we get too far into the conversation, Greg, how about you introduce yourself? I always like to hear how people introduce themselves.
Sure. So I've been in real estate for about 20 years now, both on the debt and equity side. I started my career out of college at Lehman Brothers.
Wow.
And then I joined a commercial real estate debt investment firm in the summer of 2007. So I like to tell people that I kind of jumped from one fire into another, right? Because Lehman wasn't the place to be, 07 going into 08, but then real estate credit was also a dangerous place to be with the subprime crisis and the GFC. We were investing in CMBS, whole loans, B notes, B pieces, mezz, preferred. And so it was an interesting place to be. Fortunately, the firm was conservatively invested going into the downturn, and we grew significantly over the 5 years that I was there. And then I joined to a private company backed by a family office to head acquisitions and asset management across the senior housing, real estate, and operating company side out of one pocket of capital, and then private family office out of the other pocket of capital, where we were doing student housing, multifamily, some retail, some office, some self-storage. And so had a broad exposure to real estate investments and operations, across the student and senior housing side. From there, I joined a Middle East-backed private equity firm called Safanad to build a real estate platform. I built up a student housing platform from nothing to over 9,000 beds through 10 acquisitions and 2 ground-up developments. and then established my own company named after my son, Asher, so Ash Real Estate, where I was doing student and senior housing. And today I run acquisitions and investments for Ashland Capital. We focus on value add multifamily and student housing in the Midwest and the Southeast. We also have a private credit fund, and we have about 250 million of assets under ownership, over 2,000 doors. And it's an interesting place in the market right now, to say the least.
Sure. Wow, no, that's amazing. You have such a diverse background in the space, working in with different organizations and in different asset classes and strategies and things like that. So there's a lot to dissect. Let's start with at the beginning. How did you get to Lehman Brothers? Was that where you wanted to work, or did it just kind of happen that way? Or
so, in my youth, I had been told, and I'm still a firm believer in the fact that, you want to get your base education in finance at a larger firm, a larger organization. The investment banks have really good training and broad exposure to the skill set and rounded experience that you need to establish yourself as an investment professional, whatever you're investing in, whether it's stocks, bonds, real estate, commodities. It gives you that base of understanding risk and return and analyzing opportunities really, really diligently. I had exposure to a few opportunities coming out of college, and I was very excited about Lehman Brothers. So I wouldn't say, in my youth, I wanted to be a finance investment professional. I wanted to be a doctor like my father. I had other ideas in mind, but, ultimately coming out of college, I knew I wanted to be in the finance field.
Gotcha. Wow. What would you say, and you could probably write a book on it, but what would you say are some of those kind of foundational things you learned there that even today, it sounds like 20 plus years later, that have stuck with you, that you feel have been that kind of maybe a guideline to you? Because I think I completely agree with you. I think working at a place like that, because I think a lot of people, especially in the real estate world, have this entrepreneurial spirit. They want to do that. But I think putting the foundation in at a place like that really gives you something to always look back on. So is there anything in your day-to-day now that you look back on, that you learned back in those days that's helping you in what you do today?
I'd say, quite honestly, all of it. That's a poor answer because I'm not giving you a detailed response, but it's true. I mean, it was the foundation of my career. So I leverage all of that experience in what I do today, in how I analyze opportunities, how I understand the market, how I understand how investors are thinking, and how owners on the other side of a transaction are thinking. And so it has rounded my thought process and approach to investing. One thing I forgot to mention in my kind of bio earlier on is, in addition to my real estate investing career, I teach at the NYU Shack Institute of Real Estate. So I teach master's real estate and finance. So there, I'm also drawing on that experience at Lehman Brothers because I'm teaching these foundational skills to new real estate professionals.
Yeah. Wow. That's amazing. That's got to be fun. It's a little something a little bit different, and it just to have an opportunity and an outlet to share what you've learned over the years and things like that has got to be exciting, and something that just creates impact in a different way than real estate investing does.
Absolutely.
So what would you say were some of the big differences between working for like an investment bank and a larger firm like that versus like the family offices that you've worked at? How do they operate differently? And I'm assuming that really rounded you out from a experience perspective, because I'm sure they look at things differently, right?
Yeah, there are certain differences and certain similarities. I'd say the biggest thing at a Lehman Brothers versus a more entrepreneurial, family office or other organization is the entrepreneurial spirit.
Mm.
There is less infrastructure and formal processes and rote approach to doing things at a more entrepreneurial, smaller shop than at a big institution. But ultimately, the evaluation of risk and return is pretty consistent. There may be certain metrics that are more important on one side versus another. We think a lot about cash on cash returns in our investment approach because that's a way to mitigate risk. But on the more institutional side, sometimes, there is more of a willingness to forego cash flow for greater return long term.
Yeah, that's a really good point. And I would, for like our audience specifically, accredited investors, they're not typically in the same situation that an institution would be. So the cash on cash, leaning towards that cash on cash return is very important. Would you agree?
Absolutely. Absolutely. And from an overall investment thought process, it makes a lot of sense, right? Because all the distributions you get reduce your overall exposure to the deal, right? It's what I heard from an investment professional, I don't know, 15 years ago was that they like cash on cash because it amortizes their basis in the deal. So said another way, you invest $100, you get back $5 over each of 3 years. Now your exposure is only $85.
Sure.
But that's the way I like to think about cash on cash is it's just bringing down our risk so that when we sell down the road, there's less to give back and that makes us comfortable.
Yeah, that makes sense. So it sounds like you've worked with a bunch of different asset classes. Yeah, I think you mentioned a lot of student housing, regular multifamily, private credit, office, so what would you say, what's your favorite? What would you, and I'm sure maybe that ebbs and flows, but I'm curious, kind of leaving aside the market and things like that. Which one do you just like the most from a, just the work perspective, and just which one gets you excited more than others?
I would say overall multifamily is the most exciting and has the greatest tailwinds behind it for all of the reasons that you see in the news today and that we talk about on a daily basis, right? I mean, owning single family homes has become more expensive than it's been, in decades past. Home ownership is less of a trend than it used to be, and we've become more of a rental economy. So being able to provide quality housing to people in different markets and taking a value add approach where we're improving the actual dwelling and their experience is really rewarding. Now, the student housing properties we invest in are really cool and exciting. Like they're fun, they're amenitized properties, pools, gyms, study rooms, and that's a really interesting opportunity set. But I'd say all in all, multifamily is the area where, I get most excited and see the greatest long-term tailwinds.
Mm. So, in that sense, talk to me about, some of the challenges in multifamily over the last few years and where you think it's heading, in 2025 and beyond.
Sure. So, obviously the market has been challenging over the last couple of years, just given the increase in interest rates and, the difficulty financing these properties and in certain situations, where owners had floating rate debt, that's created challenges to, having value and cash flow sufficient to cover the debt.
Mm.
Rates have come down a little bit over the last 12 months. And, given the inflation reading just yesterday, it doesn't seem like there's an imminent rate increase on the forefront. But I'd say overall, we're in the early stages of kind of a new normal with higher interest rates and some inflation. And so in that kind of market, multifamily is actually a great investment opportunity because multifamily is a wonderful inflation hedge. If costs are going up, your rent is going up to offset those costs. So we have, year-long short-term leases as opposed to other real estate investment properties where you have 5 to 10-year leases. You don't have the ability to reset rents based on inflation. So it's a very good inflation hedge and a long-term bet.
Yeah, that makes a lot of sense. What would you say are some of the differences between, market rate, versus a college, housing, multifamily, around student housing, that kind of thing? What are some of the differences when it comes to rents? Are they increasing at the same percentage on average, typically? And then how do you underwrite, like, from because you're having, what's the turnover look like? Is it every year that typically, or are people staying longer, or, honestly, I'm curious to how that works. So how they're kind of underwritten differently, and from the turnover perspective, from management perspective, I think people always assume, college kids are they're having a fun time in there, and they might be beating the place up a little bit more than the average person. So curious to some of the differences to the underwriting and that process of getting into a deal.
Sure. So student housing is different in a few ways. We're renting to college students, right? 18, generally not 18, 20 to 22-year-olds who don't have significant credit. So we get parental guarantees on those leases. From an income standpoint, we have parental guarantees on those leases, right? That are protecting it. And we rent by the bed instead of by the unit. So three bedroom unit, right? You're not signing one lease and having the 3 tenants be together on that lease and taking on the risk that, if you and I, Peter, are signing on a 2-bedroom and I flunk out of college, you're not on the hook for my lease.
Yeah.
You're just signing on your bed, and as the management company, we have the ability to put somebody else in that vacant bedroom. So that creates an opportunity to generate a little bit greater income because we can charge more per bed than we would if we were renting the unit. But the operating costs are a little higher, as you noted. Students aren't the most responsible tenants, although, from our investment approach, we try to look at areas where the colleges have better overall academic performance and higher quality income profile of the guarantors on those leases. So, we're trying to make sure that we're not scraping the bottom of the barrel from a university perspective or quality of asset perspective. And, we see an opportunity to really increase rents. Now, from a leasing approach standpoint, there is one cycle for the leases. So from a turnover standpoint, it's very nuanced in student housing. You have to be fully leased up by kind of the spring in most markets for the upcoming academic year. So for August 2025, for the 2025-26 school year, we pretty much want to be fully leased at a lot of our properties by now. In some markets, leasing starts September, October. Others, it only starts in January. But the earlier you can be fully leased, the better off you are. So it's a big churn in terms of leasing, moving tenants in, and then renewing and getting new leases signed. And in student, you generally have, 30 to 40% renewal rate because you have the seniors all graduating. You have few freshmen because most schools have a live-on requirement for at least freshman year, maybe even sophomore year. So you don't have a lot of students renewing, unlike in multifamily where it's stickier tenancy and you're able to sign those leases throughout the year. So the turnover is less of an issue. The big thing in student, because of that turnover cycle, there are 2 weeks in July prior to August where we have to turn over 70% of the units that are still vacating. And so it's a big undertaking. It's kind of the part of the year where operators of student housing, the managers, are kind of bracing themselves for the hell that is turnover because it's a lot of work.
Wow, I can imagine. Definitely a lot of trucks outside and people leaving stuff at the curb and things like that and all. And how does that factor into like the deal cycle at all? Do you tend to see those properties sold at certain times, and is there like an ideal time that you want to acquire? Because I'm assuming, as you take on a new property, it takes a little bit of time to get it, the operations of it up and running. So is there like an ideal time to buy those types of properties, or?
Yeah, you tend to see the highest amount of deal flow come in the fall after move-in has happened and
You're fully leased up.
Properties are fully leased and there's proven performance of those leases that are signed, right? So it's very easy to lease a property up with poor tenants, sell the property, and then have occupancy drop, which is a risk. So people often, and financing counterparties, banks, like to see a month of collections before they're willing to recognize the rent roll that's in place. Now, the toughest time to close on a deal is in those summer months when turnover is taking place. And, you kind of have to get through all of that work. So there is a lot of cyclicality to the sales cycle on these properties as well.
Yeah, I would think more so than just a regular apartment that doesn't have those drivers. What drives the rent, and the rent increases? Is it mainly comps and then obviously just like operating expense and things like that? Or, I'm just curious to what are some of those drivers? Is there a normal appreciation rate, or are there times when you could see a 3% bump or, 5, and then what's driving that?
Yeah, so it's really supply demand driven, and demand being enrollment, and supply is very micro market because you just have the other purpose-built student housing properties competing amongst themselves, and then multifamily properties competing amongst themselves. There is some crossover in those tenants, where somebody may live at a purpose-built student property and then move to a multifamily property. But the reason that I say that it's so micro is because if you have 2 or 3 new properties coming into a student housing market, a university market, that can have a much bigger impact on the performance of that submarket than it would in a multifamily market where the reach is much greater. But the larger universities, the tier 1 schools, 20,000 enrollment and up, state schools in the South, Southeast, Midwest that have continued to have rising enrollment and limited supply, you continue to see rent growth opportunities. Generally speaking, universities only have enough on-campus housing to accommodate about a quarter of their students. And so the other 75% have to find housing somewhere, whether that's, purpose-built student housing, multifamily, or single-family homes for rent. There's, a bigger opportunity set, a bigger captive there than at a small university with 5,000-10,000 students.
Yeah, that makes sense. I went to Temple University in Philadelphia, and while I was there, they built a lot of student housing on campus. The university, probably, I would think over 1,000 units, just on multiple large high-rise apartment complexes and things like that. I know that shook up the student housing area because Temple always had a very vibrant off-campus housing, smaller multifamily and single families that, have multiple beds that could be leased, that kind of thing. So, God, there's so many questions I have with it within the space. It's always been something that fascinates me. But there's other things I want to talk to you about too. So my last questions would be like evictions. And so if a kid's not paying, how do you go through that eviction process? How do you like you said, you have the parents co-signing, that kind of thing. So just curious how that works. I don't ever remember a time in college where the sheriff showed up to throw somebody out of a bed. I'm curious to how that process typically works.
Yeah, I mean, generally because of the parental guarantees, uh, there is a much easier way to enforce the lease
Yeah.
than, a 20-year-old kid that really doesn't care or have a sense of, full financial responsibility. When you have a parent whose credit is going to be impacted by the non-payment on the lease, it's a lot easier to get their attention than it is to get the students. So that is a big benefit to the properties. Um, there are times that, a student will move out for one reason or another. Maybe they transfer or they decide they want to live somewhere else with their friends. And so those situations can be more complicated. We do have to go to collections and chase after them, and it's a process, just like in multifamily.
Sure. Gotcha. And then final question on the student housing side. Do you typically have a relationship with the university at all? And if so, like what does that look like? How do you operate like that?
So these are private off-campus student housing properties. So there is no formal affiliation with the university. There have been times over the years that, I've worked with universities on master leasing all or some of the properties that I've had. But those opportunities are few and far between generally, and it's much more common to lease bedroom by bedroom to the students at the school. And if you have a good relationship with the school, you may be on their off-campus housing option list and things like that. But there's no commitment to the university or from the university with these properties.
Gotcha. Awesome. So another thing that you've said you've worked in that I'm curious to how it relates to student housing, because I would think there'd maybe be some crossover from a niche kind of multifamily aspect, is senior housing. That's something that that has always fascinated me, and I feel like it's one of those areas in the space that it doesn't get as much attention as other areas do, because I think there's different things that go into the operations of it that the average multifamily investor maybe doesn't want to get involved in, that kind of thing. So what's your take on that? Is Ashland, have you guys done senior housing, and if so, why? And if you haven't, why not?
So Ashland focuses on multifamily and student housing. We haven't done senior housing. Um, I have done some, prior in my career, and I do some independent work, in the space as well. Um, it is more operational. There are some nuances to it that are difficult, right? There are government reimbursement components to certain properties where you take Medicaid and Medicare residents, and that is an area that some people really don't have the stomach for because, going back 5-10 years ago, the government decided, we're going to shut off reimbursements or cut reimbursements significantly. And if that's your largest payer source, as opposed to private pay, you're getting government reimbursement, you have a lot of risk exposure. Um, I tend to focus more on the private pay side of things. So the active adult or, 55 and up multifamily communities, as well as assisted living and memory care facilities that are private pay. So it's a very operational space, but it's one where there's a huge tailwind behind it now because of the fact that we're finally at the point where the baby boomers are starting to move into these facilities. There had been a big push 10, 15 years ago to build things ahead of the baby boomer, the silver tsunami, as it's been called. But those seniors are living a lot longer than than the older properties had been built for. And so there are new needs, new demands from those residents that aren't fulfilled by the legacy existing stock. And so there's a need for new and more affordable housing. And, I think that's an interesting opportunity set.
Yeah, the niche type of multifamily opportunities have always interested me because I always feel like in real estate, one of the issues with real estate is the barrier to entry. Yeah, it tends to be pretty low, multifamily in and of itself, I think, has a little bit of a higher barrier to entry just because it takes more capital, takes more experience on the operation side, and there's a certain mindset I think that some investors have a hard time to get to. But from there, there's a lot of over the last few years, it's like, your Uber driver can be investing in multifamily. There's so many people that have entered the space because I think, these training courses, you go take a weekend, seminar and learn how to operate multifamily, that kind of thing. So I always think, I think like student housing, senior housing, like those kind of niches within the space could provide some maybe some more deal flow or, maybe a little bit less competition or what's your thoughts on that?
Yeah, I would say there's higher yield on a lot of those opportunities because of the greater risk. And it is an interesting opportunity, especially for passive investors, quite honestly, because there's a way to generate income without, without having to spend all of your time focusing on it. And that's why at Ashland, we offer the opportunity to generate income for passive investors through multifamily, student housing, and our private credit fund because, there's a lot of cash flow available, but you don't have the time as a passive investor, as a professional with a day job to be working on this stuff.
Yeah. Well, that's a great lead into where I wanted to go next was the private credit fund, because that's something you guys. I think it's a response to what's going on in the market, right? In a lot of ways, which I think is really smart. So what was kind of the idea behind that, the inception of why start that, and then how has it been, and then explain too, like what are you guys lending on, criteria wise, all that kind of stuff. Very interested to hear about that.
Sure. So, the genesis was as you noted, the dislocation in the capital markets, the banking challenges that are there today because of higher interest rates. There's a lot of need for capital, and a lot of capital providers have backed off, whether they're out of the market or their proceeds are lower. There's a need for more capital and it's hard to come by. And so we saw an opportunity to take advantage of that dislocation, but it's not as though we just started doing it. We've been in the credit space and private lending for decades. And so this is an opportunity for us to offer what we've been doing on a private standpoint to our investors. And we've seen a lot of traction, a lot of interest, and we're really excited about it. We offer 12.5% IRR to our investors paid on a quarterly basis. We offer a 90-day liquidity option to the investors. So it's not your typical fund where your money is locked up forever and you can't access it. If you invest and want to get your money back, there's a window to doing it even before the fund matures. I say that, but most of our investors are very happy to invest and park their capital and be generating 3 times what their savings account is going to be generating, and reinvest those distributions for the benefit of compounding. So that's something we've seen a lot of interest in from our investors and are now offering. And then our capital in the fund, our 10% in the fund, is in a first loss position. So it would take us losing all of our capital before that impacted investors. And it's an interesting risk-adjusted return offering in the market today. What we're doing in there is we are doing fix and flip originations. These are 12-month loans with high yield, low teens, where we don't hold the loans to maturity. We actually sell them off to hedge funds and banks just after we originate them. So the way we make our money is through the origination fees and the yield spread. So we originate the loan at a 13% rate.
Okay.
You, as the bank, buy it from us at a 12%. And so we get our 2 or 3 point origination fee and the 1% spread between our 13 and your 12 that you bought it at. So there, it's about turning the money quickly and just having a huge pipeline of opportunities and being very careful about how we're underwriting and making sure that that lines up with our buyers on the other side. The second piece, and this is very familiar to, I'd say, you and everyone who's listening, is preferred equity. So, we provide preferred equity to the sorts of multifamily and student housing deals that we would otherwise be investing in, but we have more equity protection. So, debt used to be, let's say, 75%. Now it's 65%. And we're providing that 65 to 75% gap on deals and able to generate really outsized returns for those loans or investments. And then the last piece is that we're doing private credit lending. So we provide small loans to private companies, private businesses, and we originate those at a factor rate. So a factor rate is basically saying, instead of charging you interest, we increase our due from amount by a factor. So we give you $100,000 at a 1.3 factor rate. So we give you 100, you owe us 130. Over 6 to 12 months, you pay that back, interest and principal. And so our returns on that side are incredibly high, incredibly attractive.
Yeah.
Now, it's not without its risk. I don't sit here and try to tell people that, it's super easy and super bulletproof. We do have some defaults in that space. The industry average is about 12%, and we see about 6% across our portfolio because of our careful underwriting approach. Now, we also make micro loans in that space, so $5,000 to $30,000. And so we're able to have a very diversified portfolio and spread our risk significantly, not just on the small business side, but across the preferred equity and the fix and flip originations. So the credit fund is very, very diversified and not the sort of situation where, you're exposed to 3 deals, one of them goes belly up and now you have a problem.
Sure. I think that's a very unique and beneficial, kind of setup, because a lot of times you see those funds that they like you said, they just kind of lend to fix and flippers. And I've seen, business funds where they're lending to, small businesses or whatever, and they don't typically cross over into, the different areas and things like that. So I think it's interesting to be able to provide that kind of diversification in one fund. How the heck are you sourcing all those deals? Are you doing that in-house, or do you work with other parties and they bring the deals to you or something? Or how are you sourcing the deals?
It's both. We have a few groups that we work with across, the small business credit and the fix and flip side. But we also generate a lot of the deals through inbound interest. We have a big network of relationships, and so people will come to us and say, "Hey, I have somebody who's looking to get some money. Would this work for you guys?" And so, we work on those directly while also leveraging our relationships in the space to build up the pipeline. And our pipeline is really robust today. And, we're continuing to get investment and make the distributions to new investors. So it's an open-end fund, and, continuing to speak to people who are interested in investing.
Mhm. And speak to me about the private equity side, because or preferred equity side. I think that that's been such a popular investment over the last few years. My email box has been flooded with preferred equity deals, and I haven't taken as much time as maybe I should in some ways to really look into the details. But one thing you said earlier that I think is really important is your guys' mentality on the higher for longer, in interest rates and things like that. Because I got to think, if some of these people who are originating and underwriting and making these preferred equity investments, that if they're thinking there's rate cuts coming, that could, they could be maybe making, poor decisions, or two from a investor that's taking the preferred equity into their deal. If they're setting that interest rate or something like that, thinking there's going to be rate cuts and they're going to be able to refi out of it sooner than later. I mean, what's your take on that? I mean, could there be a little bit of challenge coming to the preferred equity space if you're not underwriting, for that higher for longer, if you're thinking, oh, there's going to be, 3 cuts in 2025 or something like that? Because I feel like that's something a lot of investors have been doing lately. And in my mind, I just think if you're taking on, higher interest kind of bridge money like that, you're assuming it's going to be pretty short term. And that the only way it's going to be short term is if rates come down and creates more value and you can refi out of that.
Yeah, so I'd say there's a lot of questions to respond to there. The interest in preferred equity in this environment is that some equity in legacy deals has just been wiped out.
Mm-hmm.
And their owners are viewing the preferred equity as a hope note to keep the deals alive. We are less focused on those sorts of deals that are underwater, where we may be giving the owner a lifeline.
Mm-hmm.
We're more focused on carefully underwriting the deals, making sure that we have real equity protection, not legacy equity that is wiped out and we're the first loss.
Mm-hmm.
We know that there is capital below us, and we also try to structure these to help the sponsors on the other side. So we don't take all of that interest as current pay. We can accrue some and get some of it current, but our rates are really high and they're equity-like returns. So, we're 20s plus, half current, half accrued. And so we're getting compensated for the risk we're taking on, but we're getting equity-like returns. And that's the reason you've seen a lot of capital come into that space over the last few years, because where real estate deals have been harder to come by because there's been a bid ask and financing has become more expensive, preferred equity has been an opportunity to generate those equity-like returns with lower risk. And we like that trade. That's not to say that we're not doing real estate investment and we're not doing real estate deals. We like both. And we think credit, private credit, and real estate are part of an investor's balanced portfolio. So, we actually closed on a real estate deal just a couple of weeks ago, which was a new build multifamily deal in Louisville, Kentucky, 2023 delivery, where, we call it value add, but it was really core plus type risk, just marking rents to market and burning off the loss to lease. So, really in this environment where it is likely higher for longer, or at least higher for now, value add, I'd say, has taken a little bit of a different definition, a little bit of a different profile. There are distressed opportunities that can offer value add returns, and there are new build opportunities that are a little bit more core plus with value add return profile. But your old, value add approach, buying a 1970s vintage property and renovating it and increasing rents, is a lot more risky now, because your exit on a deal like that and your ability to finance a deal like that is much more impaired in this environment.
Wow, that you make a really good point there, and I think as investors, a lot of them need to rethink the way they've been investing in multifamily over the last few years and all. And it's like, what worked for you, a few years back isn't going to work for you in the future. I think that's a really, really good point. And it was actually one of the questions I wanted to ask you was like, what are you guys doing in the multifamily space today? Are you still looking for deals and finding deals and all that kind of stuff? So, very interesting to see how you've taken into consideration what's happening in the marketplace, factored in where you think things are heading, and has kind of adjusted, your acquisition strategy to that. I think that's what you have to do, right?
Yeah, I mean, the exciting thing and the interesting thing about real estate and investing generally is that it continues to change. It continues to evolve. I like real estate more than I like stocks, quite honestly, because there's less volatility in it. But real estate continues to evolve and continues to change. Early in my career, we were in an upcycle, right? Everything was growing, the market was great, and then the GFC hit, and the world fell apart, and it seemed like there was no coming back from it. And then 15 years later, things had just been on an upcycle over that period of time. And then rates went up, and didn't just go up, they skyrocketed. And, now we're adjusting again. So investing generally is a little bit cyclical. But the thing I like about real estate is that long-term it trends up. And as an active, involved sponsor, there are ways to create value even in challenging markets. And so that's what we try to offer our investors, is the comfort of knowing they're investing with a group that is going to really, really work hard for our capital and theirs and create value.
That's awesome. Well, Greg, I think that is a perfect place to leave the conversation. I don't think we couldn't have manufactured that any better. That wasn't scripted. That was a really good, end, I think, to the show, and a great place to leave it. How can people find out more about Ashland and you, Greg, and how can they get involved?
Yeah, so our website is Ashland, ASHLAND, capitalfund.com. I could be reached on LinkedIn, or my email is greg@ashlandcapitalfund.com. Happy to speak to people, happy to explore ideas, and I really appreciate the time, Peter.
Well, I really appreciate having you. And, when you said that, one other question that came to mind there, was that just a total coincidence that your company was called, it was Asher, right? But after
Ash Real Estate and Ashland Capital, complete coincidence.
In your so you had to think, there's something's right here, and I
was like, it's fate.
Yeah, exactly. Fade and there's great people at Ashland, so a lot of reasons why you would want to work with them. But and I love Alex, but when you said that earlier, I just thought that's funny. Like, he had to have thought, but when you made that decision, there was some fate was involved in bringing you guys together and all.
Well, I've known Alex for years, and the Ashland Ash name aside, I knew that I was aligning and joining a aligning with and joining a great organization with great people. So very excited about it.
That's awesome. Well, Greg, thank you so much for being here. I appreciate your time. This was a great conversation.
Thank you, Peter. Appreciate it. Have a good one.
Thank you. You too.